There's a group of investors on Wall Street who don't care if a stock goes up. They don't get the upside, ever. They only care about one thing. Does this company survive long enough to pay them back? And right now, those investors have looked hard at SpaceX, and they're quietly backing toward the exit. Here's the strange part. The same week, Wall Street's biggest banks stamped a strong buy on SpaceX, one of them with an $800 price target. The bond market was trading SpaceX debt like it might not make it. Not investment grade, junk, two markets, same company, same week, completely opposite stories. By the end of this video, you'll know exactly which one to trust and how to read the same warning signal yourself months before a stock ever crashes. I've spent 15 years managing risk inside investment banks, and if one lesson stuck, it's this. The stock market tells you what people hope. The bond market tells you what people are afraid of. And when those two disagree this loudly, you stop and look. So let's follow the money. Start with the rocket that went the wrong way. In June 2026, SpaceX finally went public. IPO price $135 a share. It opened around $150. Within days, it touched $225. Everyone felt like a genius. Then gravity showed up. 5 weeks later, the stock was back under its IPO price, around $124, down roughly 45% from the top. Somewhere close to $1 trillion in value, gone. Now, part of that drop has a boring explanation. Early investors were finally allowed to start selling, which flooded the market with shares. But that's the surface story. Underneath it, something more interesting was happening. Picture that first morning, the most famous founder on the planet ringing the bell, retail investors piling in because it's Musk, and Musk means rockets, Mars, the future. For a few days, it felt less like a stock and more like buying a piece of the future itself. And this is where most people stop paying attention. The stock fell, so what? Stocks fall. But the interesting question isn't what fell, it's who saw it coming. When SpaceX went public, 23 banks lined up to sell it, led by the biggest names on the street, and their research desks were glowing. Raymond James, $800 target, Morgan Stanley, $300, Bank of America, $235. Stack up 29 analysts, and the average target landed around $236. Sit with that for a second. The stock is trading near $124, and the experts say it's worth nearly double. Only two voices broke ranks. A firm called Moffett-Nathanson said there was, quote, simply no credible financial model to justify the price. And CFRA did the one thing Wall Street almost never does on a red-hot IPO. It said sell. So far, that lonely sell call has been the most accurate one on the board, but even that isn't the real story, because the loudest warning didn't come from a stock analyst at all. Let's talk about bonds for a minute. When you buy a company's stock, you're betting it gets bigger. The upside is unlimited. When you buy a company's bond, you're just lending it money. Best case, you get paid back with a little interest. That's the whole prize. No moon, no Mars, no $800 target. So bond investors don't dream. They can't afford to. Think about lending $5,000 to a friend. You're not hoping he gets rich. You just want your money back. That mindset is exactly why the bond market is the most honest room on Wall Street. So what is that room saying about SpaceX? Some of its bonds slid to about 90 cents on the dollar, yielding around 7.5%. In plain English, lenders are demanding to be paid like there's a real chance they don't get paid back. There's a number the pros use for this. It's called a credit spread. Basically, how much extra interest a company has to pay compared to lending to the US government. Forget the jargon for a second, just remember the direction. The wider the spread, the more nervous the lenders, and SpaceX's spread is trading wider than the average junk bond, wider than companies everyone already agrees are risky. Now the twist that should stop you cold. Officially, SpaceX is investment grade. S&P rates it triple B. Moody's, Baa1. Fitch, triple B+, all stamped stable. On paper, about as safe as a company gets. But the traders betting real money are ignoring that label completely. One analyst put it perfectly. Investors are pricing SpaceX debt as if the rating label were fiction. Read that again. The people with actual money on the line don't believe the official rating, and historically, they're the ones who turn out to be right. Think back to WeWork. Its bonds were sinking well before the whole IPO story fell apart in 2019. Or 2008, when mortgage bonds started cracking months before the stock market admitted anything was wrong. The bond market usually gets scared first, quietly, before the headlines catch up. So why are the lenders nervous? Simple, SpaceX loses money. S&P expects it to keep burning cash all the way to 2029. The stock is priced at over 100 times sales, roughly 30 times richer than the average company in the S&P 500. Starlink, the satellite internet arm, is genuinely working, something like 12 million subscribers, but it's carrying a business valued as if it has already conquered the solar system. And there's one more thing lenders quietly hate. Elon Musk controls the votes. Moody's came right out and flagged it. There's very little independent oversight. When one person controls everything and the company already burns cash, the people lending the money get twitchy. That twitch shows up in the bond price long before it shows up in a headline. So, who do you trust? The banks that earned around $500 million in fees selling this IPO? Or the lenders with nothing to gain and everything to lose? Honestly, that gap is the part that should worry you more than the falling stock price. One side gets paid to be optimistic, the other side only gets paid if they're right. And you can check this yourself on any big company in about 5 minutes. You don't need a Bloomberg terminal. Look up whether the company's bonds are trading above or below 100 cents on the dollar. Look at the yield on that debt and compare it to a normal, safe bond. If a company is paying way more to borrow than its peers, the smart money is nervous, no matter how green the stock chart looks. That one habit will make you sharper than most people shouting about stocks online. So here's the line to remember. The stock market prices the dream. The bond market prices survival. And when they scream at each other this loudly, the bond market is usually the one telling the truth. This doesn't mean SpaceX is going bankrupt next Tuesday. Maybe Musk pulls off another miracle. He's built a habit of it. But the warning light is on, and it's been on for weeks. And now you know where to look for it on every company you follow, and not just the stock chart everyone stares at, but the credit spread, the bond price, the quiet market that refuses to dream. If this changed the way you see the market, do me a favor and hit subscribe. It genuinely helps the channel more than you'd think. And I'm curious, does credit spread still feel a little fuzzy? Drop your question in the comments and I'll answer it personally. And if you found this interesting, there's another video right here I think you'll really enjoy.